Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, and I'm your voice in the mortgage industry. And thanks very much for tuning in. Thanks very much for listening each and every week. The show is aired on several radio stations. Now we're expanding it into a couple of different states. And we do appreciate anybody who listens to the show. Usually it's a Saturday morning, Sunday morning kind of show where you're driving around. Either you're going to the local hardware store, or you're coming back from some kind of worship service and you flash us on AM or FM radio. We give you nuts and bolts solutions to problems that you may be experiencing trying to get a loan. This isn't a rah-rah show where we're saying, hey, come and see us. No, we're going to provide you with answers from real people. All walks of life in the show include people who are in the inspection business, title, escrow, certainly loan officers, real estate agents, lenders, presidents of banks. We bring psychologists on to talk about the difficulties in a situation like we're dealing with right now in the country and in the world with the pandemic that's going on. It affects a lot of people, and a lot of people get affected by just hearing the show and that there are solutions. So if you're one of those people, tune in. You can also see us. We're on YouTube. Go to Jeff Barton, The Mortgage Voice. You can see this as well as hundreds of other shows about the mortgage industry, about what we do each and every day. I had a friend when we first started the show said, you know what, there is nothing you can tell me about mortgages that's going to last more than 5 minutes that'll hold my attention. Well, maybe, but if you are buying a house and you do need some information and you are afraid of everybody you talk to, because in our business, like any other business, people are there to make money. Now, it's not a bad thing that they make money, but can you trust them? Well, this is the show that you can trust, because I don't want anything from you. If you happen to call us, great, but you don't need to. What you need to do is to try to educate yourself as to what some of the problems might be, or some of the solutions definitely are. In this particular climate, there are many challenges. Now, we've talked about it many times on the show. We also do a Mortgage Minute, which is on LinkedIn, as well as Facebook, Instagram, Twitter, on a daily basis that brings you a minute, 2 minutes worth of solutions in those particular areas where you're going to need some information. Now, that information today, let's talk about it, okay? We're also on 8 different podcasts, and there's many ways that you can see us. We're on iTunes, we're on iHeartRadio, we're on, what else are we on there, Daryl?
Well, we're on Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, radio.com, and you mentioned Great. YouTube already.
Great, excellent, perfect. So, these are all the things that we can do in order to help you. So let's just run through some statistics. I wrote them down here so I wouldn't forget. Let's see. Okay, these are April numbers, right? We're in mid-May, but most of the economic data that you ever hear is in the past, right? The prognostications are what they call futures, and you can go to the stock market and see what they think. And again, that's a totally different situation. But so we're talking about past numbers. 20 million plus jobs lost. Now we know that unemployment is up to 36 million. So like I say, this is in the past. The housing starts, and this is important. People building houses is one of the essential businesses that were declared in the U.S. So if you're one of those people who work in the construction field, good, because we need you. We need more housing. However, the total number of housing starts are down 30%. Now, usually on a given year, we probably are short about 1 million houses a year in the U.S., which is one of the reasons why the housing prices are so high and as high as they are. We need to build about 1.5 million houses a year to at least stay current, and probably more than that in order to catch up. Well, we're down 30% from 1 million. So if we're building about 700,000 to 800,000 houses this year, we're going to be an additional $300,000 short on top of the amount we were already short. Now, what does this tell you? It tells you that the price that you're going to pay for that house is probably not going to be as affected as much as the economy turning down, all these people losing jobs. There's an offset there. We don't know what the offset is, because this particular recession is brought about by the pandemic, right? So instantly, 2 months, 36 million people on unemployment. That's just in the US. That's never happened before. Normally in a recession, you build up for it, and these things take time in order to get those kind of numbers. But because of the fact that it's happening now and those numbers are so huge, we're not quite sure how it's going to affect prices. The offset, as I said, is the demand for housing was huge. We were getting multiple offers, prices were going up, albeit not as fast as they had in previous years, but the housing shortage is exacerbated. It's getting bigger. So if that's true, that means housing prices will probably be stable. What we have seen so far this year, even through the first 2 months of the pandemic here in the US, is that housing prices have actually risen by 3%. So it'll be interesting, and obviously for those out there looking for real estate and looking for something to buy, this is of ultra importance to you. The reason being is you cannot get into a home unless homes are available, and you cannot get into a home unless you have a job. The two things that are affected most in this issue, in this problem, are housing prices and the availability of funds. Both really need you to have a job. Let's look at some other numbers. The building supply chain, that's one of the main issues that we're dealing with when building houses. It's not so much that we have less demand. No, it's not that. It's that all along the chain, there are people who provide the wood, the nails, the labor. You just mentioned hundreds of things that go into a house. The plumbing supply people, the plumbers themselves. This is just one aspect. The heating and air conditioning. I mean, sure, I can go on and on. Suffice it to say that when we look at housing, we normally look at the number, right? How many houses, how many permits, how many houses were built last year. But the supply chain with which to get these houses built has been interrupted, and we're not quite sure which industry is going to get hit next. Everybody's heard the stories about the poultry factory that has, I forget what it is, which one it is. Do you remember which one it is, Daryl?
It was on the East Coast somewhere, but they had like 2 million chickens they had to off because they couldn't take care of them because of the.
Right, exactly. So that's the food supply chain. Well, in the building supply chain, it's the same thing. Now, you may not have nails that get sick, but you have people that make the nails, people that deliver the nails, people that work in supplying hardware stores and shipping you things that you need. So all of these elements are causing that issue in the supply chain, which causes, again, a need for more housing because the demand is there, but the supply is not. So that's one thing to consider when you're looking at new houses or any houses and why the prices haven't begun to fall. Let's see. Okay. The future permits in home construction down 20%. So this tells you that the builder is saying, okay, we're not sure about right now how much a loss of a job is going to affect home purchase. So because since 2008, 2009, and those years which we had the economic recession, or the Great Recession, they're calling it. The problem in those days, those years, was we have never recovered our building capacity. Meaning, let's say you go to a town like Phoenix, Arizona, or you go to Las Vegas, Nevada, and there are many on the West Coast, many cities that had expanded up until 2008 extraordinarily. Huge infrastructure projects, many houses being built, thousands and thousands of tracks. In Florida, after the recession, you saw all the units being plowed under, being taken down because they were just vacant. Well, because of that, there's such a scare in the building industry that nobody wants to take a gamble of building more than the demand that they see and they can afford to build and borrow on is doing. So there is a scarcity of homes because of the fact that the builders do not want to gamble. And this time it looks like they're right, because obviously the demand is going to be down somewhat simply because people are losing their jobs. And when people lose work, they do not want to go out there in the marketplace and spend on big ticket items. Ask yourself, if your job is tenuous or you're not quite sure, do you really want to take on a mortgage 30 years at $3,000, $5,000 a month? I don't think so. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You can hear us on a number of different podcasts. We're on all the big eight, whether it's Apple or Google or iHeartRadio. There's a thing called the Big Eight in podcasts, and we're on all of them. We're on 5 different radio stations in 3 different states, and we're usually a weekend drive around and to the hardware store kind of show where you're looking for some information about how you're going to get your next mortgage. What's the house going to be like that I want to buy? Who do I talk to about getting some information? I know out there in the marketplace, people aren't trustworthy. I don't know why. They're just not. So this is a place where you can go each and every week. You can listen to what we have to say. You take it for what it's worth, but it is a safe place that you can get information for nothing. I am a loan officer by trade, own a company called Malibu Funding. But as I said, you owe us nothing. The Mortgage Voice is here for you to listen to and get some education about what we're trying to do to help you in your search for either a loan or a house. We bring to the show every week different people from different disciplines in the lending and real estate business. This week is no exception. I'm really happy to have him on. He's a guy I've known for maybe 20 years or more. It's Phil Burson. He works for Compass Realty out in Calabasas. Is that right? You work in Calabasas, Phil?
Yes. Hi, Jeff. Thank you for inviting me to the Mortgage Voice. Yeah, I'm in Calabasas. I've been a resident out here for 23 years, and I've been selling real estate for most of that time in LA County, San Fernando Valley, and down into Malibu.
Okay, excellent. I have a few questions because obviously we're in a very unusual time for real estate. Usually we're booming, and the economy in real estate and loans was really doing quite well before this particular health crisis happened. How has it affected your business and the market in your area?
You know, in our area, things have been fairly steady now. In the beginning of March, they really dropped down where everyone was very fearful. Everyone was afraid to go out. But quickly we pivoted and went virtual. So we've been doing many virtual buyer consultations, sales consultations. We've been marketing homes using 3D virtual technology. And over the last month or so, things have really picked up for us. I think the public is getting a little more used to going out right now, used to dealing with this technology that we're using.
Okay, for sellers out there who are listening to the show, tell us what you do in terms, like obviously somebody has to go in and see the home at some point. Obviously someone has to inspect the home at some point. What kind of safeguards or what procedures are you using as a realtor or as a real estate company?
Yeah, well, we are governed by the California Association of Realtors. They've been changing the rules that we need to adhere to pretty much every week. But we are putting on, when we do go to properties, we put on our masks, booties, gloves. We have certain advisory forms that the sellers, the buyers, and agents all sign. But before we get anyone into homes, we show everything virtually. So we do the tours I previously mentioned, and then we make sure that the buyers are qualified. They've seen all the virtual tours. They've driven through the neighborhoods. They've looked at the photos. They've asked all the questions. They've done their research. And then if they want to go see and the seller and buyer are both comfortable, we'll have them fill out the forms, gear up, and we'll go show them the property. Typically, if the house is occupied, the seller will leave the premise to go out back, and we'll go in with the agent and no more than 2 people at any given time. So we still are doing tours of properties, and that just changed about 2 weeks ago. Before 2 weeks ago, we weren't even allowed to do that.
I see. So obviously, you're going to see an uptick in volume of people wanting to buy homes because now you're allowed to do some more stuff. It's better for the buyers, right? Did you find that buyers were a little reluctant themselves? So we talked about the seller. What about the buyer?
The buyers themselves too. I mean, as you know, we find all types of people with all levels of comfort out in the market right now. But the buyers, they've been willing to go in. And the good time about selling or buying right now is that the people that are out there looking are very, very serious. So you might have fewer sellers, you might have fewer buyers, but there's just as many good transactions to be had at this time.
You know, that's very interesting that you said that. It's something I hadn't even thought of. Of course, people who are out there now are very serious, so that you're probably guaranteed a higher closing ratio, I would imagine.
You do. We do have a higher closing ratio. Just as a case study, we had a listing come on market about 25 days ago in the San Fernando Valley in Encino, just around $1 million. And we had many, many views. The views online are off the charts right now.
Right.
The stats from Zillow, Realtor.com, any of the main portals, or Compass.com, you'll see that everybody's at home. They're looking at things. They're spending more time per property online. And so there's a lot of demand that way. There's a lot of people looking. And then again, just get them out there to see the properties. And we're able to, out of hundreds of views, so that's what thousands of views, we had 20 direct inquiries. We had 5 private showings, and we got an offer, and we came to terms. And we came to terms within about 5% of the asking price, which was really very good.
You know, I think that is really good. I think the thing here is that the real estate community is really geared up for this, right? I mean, we've been, I guess, 20 years in the making of trying to make our entire business online. And I think as a result of that, you're finding that the technology in place is really being utilized much more than it was, but at the same time, the industry itself is prepared for it. How have you prepared for it? Do you have a website yourself? Do you have a way people can get in touch with you? How does it work?
Yeah, I mean, we're fortunate to be aligned with Compass, Compass.com. We're the third largest company, privately held real estate full-service brokerage in the United States. So we're very tech-driven. We've got 400 full-time engineers working behind the scenes to enable the consumer and the agents to work remotely and provide all the tools in the world. So we've really pivoted. We've used their tools at the Barton Group. We've done what we need to do to communicate with our clients, not only share our opinions, but share data with them. So get the real numbers about the market, about how many properties are on market, how many have been pulled off the market, what it looks like now mid-COVID, and what we see things as after COVID.
Okay, so okay, give us your opinion. What do you see things like after COVID, or when do you see that happening?
You know, a huge demand, Jeff. It's a great question. Right now, things, at the very beginning of COVID-19, things slowed down. And just sharing some data with you, over the last 30 days, so this was for the month of April. So we just collected these stats the last couple of weeks. But month over month, from March to April, we had 457 listings come on the market. This is LA County, which was a 16% increase from the month of March. So again, everything slowed down, and then it went 16% up. The number of homes sold during the month of April, 428, which was a little bit less. That was a 27% decrease. But that thing stopped in March, and then it takes a while to catch up for homes to get into escrow. Median sold price in the month of April was down about 5%. The average for LA was actually $1,570,000. So, that's an interesting data that everyone wants to know. And, a lot of people think the market is going to go down considerably. We don't see that. We see it, just nationally as 5 to 10%, and in LA County and Ventura County, because we do have such limited supply and such high demand, lower prices are maybe 3 to 5% down. But we see once we get out of COVID-19, once the stay-at-home restrictions are lessened for us, it's going to be a huge pent-up pent-up demand for housing. For instance, there were in LA County 227 homes, put on
Phil,
homes.
we're up against the clock, Phil. So I gotta cut the interview short, but I want to give you an opportunity to tell people how to get in touch with you, especially over in your market area. How do people call you or email you?
Thank you, Jack. The bersongroup.com. So BERSON group.com. Telephone 818-425-7757. We are on all social media under the Barton Group. And it's myself. My partner happens to be my daughter, so I'm very privileged with that relationship.
Yeah, say hi to Ari. I appreciate the time, Phil. Thanks very much for coming on the show.
Okay, thanks for having me, Jeff. Take care now.
Very good. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. If you want to hear this show, we're on a number of different radio stations, 5 radio stations in 3 different states, as well as on the Big 8 podcast. So if you need to see us, just look up Jeff Barton, the mortgage voice, and you will hear me. Locally, what we try to do is also record the show for video, and we put it on YouTube. Jeff Barton, the mortgage voice, is my YouTube channel. So there's lots of ways that you can get this information. This is not a rah-rah show about me or the company that I work for, Malibu Funding. What we're going to try to do is bring you answers to problems that are currently in your sphere. I mean, obviously, if you're trying to get a loan right now and you don't fit into a natural box of loans for most companies, you're fretting a little bit and you're in that purchase contract and you can't figure out a solution. Well, we bring people who can fit in a box, people who don't fit in a box, anybody who can help you to try to get that information. With us today is no exception. First time on the show, Kevin Piranillo from PRMG. He is the Chief Lending Officer, which is an incredibly important position, especially in today's times. Kevin, how are you?
I'm good. Thank you for having me on the show. I really appreciate it.
Thank you very much. Okay, we're going to ask you a couple of questions about some solutions. You see a lot of loans come across your desk and to your company. What are you seeing as some of the major blocks for people getting loans currently in this market?
Well, it's interesting, with the disruption from coronavirus, the industry has faced a liquidity crisis, and we actually have the lowest availability of credit in our industry in over a decade. And what's interesting is that, having said that, it's still the busiest it's ever been from a refinance standpoint. So, kind of a short way to think about our industry, we buy and sell money on the secondary market, and everything is packaged up into mortgage-backed securities. And, the most liquid and the most explicitly backed securities by the government are your Fannie Mae, Freddie Mac, and Ginnie Mae loans, commonly referred to as GSEs, the government-sponsored enterprises. So we're seeing a lot of conventional loans, both Fannie Mae and Freddie Mac version. We're seeing a lot of FHA, USDA, VA. VA loans, there are more loans for veterans in the first quarter this year than FHA loans. That doesn't happen too often. That was a pretty interesting stat I saw yesterday. And unfortunately, what's been kind of cut out are what's called non-qualified mortgages. Those were like the ones that, like specialty loans, 1 year out of foreclosure or bankruptcy. There's been a lot less market for that. Jumbo loans, even jumbo loans for very high-end credit borrowers, those are loans that are not as liquid. Those are balance sheet loans. So unfortunately, there's less options in credit available on those products. So we're seeing a lot of refinances on your standard loans, your basic loans, under $500,000 or under $450, or just depending on where your county is and where you sit. That's the most of what we're seeing right now. But having said that, people are getting a little bit hopeful about, there's less jobless claims, there's less forbearance claims, there's less disruption. The data is getting less worse. So hopefully that will start to open the credit markets back up again and get more product moving,
Yep.
And I'd be remiss if I didn't mention that HELOC lending, their second liens. Several major banks, have just said, hey, we're not doing these anymore. So, it's interesting, a lot can change in just a couple months, but it can also go back the other way, in 60, 90 days time as well.
That's interesting that you say that. Okay, so the evidence looks like things are slowing in terms of unemployment or in terms of other things that are negative on the economy. You mentioned the liquidity issue. Explain that a little bit more for the listening audience who doesn't really understand why, if they're trying to apply for a loan and it's only $300,000, why they're being told that the credit requirements are higher just because the safety factor is less. And so therefore there's less money in the system because everybody's a little bit scared.
So there's an old adage in the industry, and look, I don't work for a bank. I work for a
Right.
private banker. I'm actually one of the 4 partners. I'm 43. I've been in the business 19 years last month, and so I just give you a background on me. But there's a funny saying I heard many years ago. They said, if you have a $100,000 loan, you have a problem. If you have $1 million loan, the bank has a problem.
Mm-hmm.
And these borrowers who are qualified, think about people who are professionals, doctors, lawyers,
Right.
business owners, people who have perfect credit and never missed a payment. They're sitting there saying, what's the problem here? Why is it taking so long? Why are you asking me why I disputed a charge on my credit card bill? I disputed the charge because the airline, was a jerk. I paid every payment ever in my life, including my credit card bill. I mean, that's literally how tight some of the underwriting has gotten on absolutely stellar borrowers, especially on the jumbo end. Loans that are $750,000 or higher, $750,000 $1 million loans. These
Right.
borrowers know they're good. The banks don't have. They're being tight with their money because there's a lot of uncertainty. So when I talk about Fannie, Freddie, Ginnie loans, just your normal loans, your agency loans, loans in that 350 range, those are all completely backstopped by the government. So
Right.
so those, there's some certainty surrounding those loan products. And remember, if someone does a loan, it gets packaged up into a mortgage-backed security, a big pool of loans. You do one loan for $350 in your example, then 100 of them or 1,000 of them get packaged up into one large mortgage-backed security, and then sold on the secondary market as a very low-risk fixed income asset. It's
Right.
like a bond. And so when the CARES Act came out and said, okay, look, if you have a hardship, you can get up to 12 months of your payments, in forbearance. So you don't have to make a payment for 12 months. So that was great for borrowers who were facing a true hardship, but it placed a lot of uncertainty for servicers. So even servicers of Fannie, Freddie, and Ginnie loans, your FHA loans, they said, okay, these borrowers may not make payments for up to 12 months, but we still have to front their payments on past
Right.
loans
Right.
because we got to make sure the bondholders are good. So everyone started saving their cash. Like, oh my gosh, how much do we need to front payments to the bondholders for borrowers that go into forbearance? Hopefully, rightfully so, because they lost their job or they're on furlough or whatever. And so liquidity just dried up. So doing new mortgages, there's just less buyers. There's less. Even Wells Fargo and Chase Manhattan.
Right.
These are your largest financial institutions. They said, okay, there's uncertainty in the market. We need to conserve cash. And they made restrictions on loans. And so, that trickles down and reverberates throughout the industry. And I could go loan product by loan product here if you want me to bore your audience. But certainly, there's less money. There's less money, so it makes it harder to do new loans because all the people who front the money are like, okay, how much do we need to make sure we can get through this forbearance issue? To make sure we can take care of loans that ultimately default, because 36.5 million people in 8 weeks lost their job. How many of those aren't going to be able to make their payment and turn into a foreclosure? So now the servicers have to go do foreclosure. People are modeling out right now. All these servicers and banks are saying, okay, if I have 10% of my book that doesn't make 6 payments, I'm going to need, $50 billion to front payments and get through all the foreclosures, make the tax and insurance payments on behalf of all these borrowers that aren't going to pay. And so it just puts a lot of uncertainty in the industry for the people that fund the liquidity to do the new loans. And that's why rates aren't as good as they should be. There aren't as much product as there should be. And people who have good credit and they know it, they're getting put through the ringer, and it's unfortunate. So it happens very quickly, and I can tell you there's tremendous effort on the back end, to make sure that we get, back to a normal credit market. Having said that, we came into this recession, the housing market was on absolute solid footing. No bubble, everything fully documented, no liar loans, the best collateral in history, the best loan quality in history. All the financial institutions are the best shape they've ever been coming into a recession. And so it's been, thank God for that solid footing. And that this was kind of a forced recession, a forced lockdown because of an unexpected swan death, a bat virus out of, Wuhan, China, and so it's just very interesting to see how it all is playing out. But I'm very hopeful. Things are certainly starting to look better.
Kevin, we've lost Jeff through the connection. Why don't you give us your contact information? How can people get a hold of you?
Oh, anyone can email me. Find me on LinkedIn. That's probably the best thing to do is to come to LinkedIn. I'm on LinkedIn under Kevin Peranio, Peranio. I do about 5 or 6 little 10-minute videos a week just talking about the news going on in housing, and I throw in some little things like the little test that, spat that was going on about the Fremont plant, and talk about finding a cure, and, just different things and how they all kind of relate together, and try and make it a little bit broader than just industry specific.
Well, thank you, Kevin. It's been very informative. We'd love to have you back in the very near future. Thanks for participating today.
Yeah, anytime. I'm happy to help. Thank you so much.
Okay, bye-bye.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show and tuning in. We're on 5 different radio stations now in 3 different states. Our Inland Empire crowd has grown to a larger group that covers a great distance. We're in Vegas, we're in Albuquerque, New Mexico, as well as up in Lake Tahoe. Appreciate people who listen to the show. We get great feedback, and obviously providing the service of information about mortgages, about how to get a mortgage, especially today when, it's not easy, and trying to figure out why. Today's show has kind of been about that. And to further that end, we bring on to the show a guest that's been on the show many times, and he comes from the lender loan stream. It's Tomas Trujillo, and he joins us now. Tomas, how are you?
I'm great, Jeff. How are you doing today?
I'm okay. Thank you very much. We've had some technical difficulties on my end with the show, but the show itself is good, and my family's good, and I hope yours are too.
Absolutely. Trying to stay quarantined and safe.
Okay, great. So Tomas is and you are an account executive over at LoanStream. Tell us a little bit about how your job has changed today versus the way it was a couple, 3 months ago.
The whole world has gone topsy-turvy. I mean, nowadays we've lost because of the big FHA scares, Jenny Mae's and non-prime taking a huge hit. There is no more non-prime, but we have very limited access to it. Now all we're doing is bank statement loans, 12 and 24 months. We lost our DPA programs. We lost our low FICO for FHA. So we're just trying to do bread and butter loans right now that we need, hoping that everything turns around fairly soon.
Okay, so you mentioned bank statement loans. Walk through both of those programs for us, if you would, please, just because I know there are people out there who don't fit into a traditional situation. Their situation is a little different, and this bank statement may be something that they can use.
Well, absolutely. So if you have somebody who's not claiming all their taxes and they're making the money. The only way they can show it is on the bank statement. So we're doing 12 months bank statements. We're doing 24 months bank statements. You can do personal. You can do business. We'll give you about 85% of the total deposit. We don't care what they're left with. If they deposit 100,000, we'll give them about 85,000 of that. We don't care if afterward they're left with $5 in the bank, they transfer the money out. As long as I see the money coming in, that's what I'll take.
Okay, how do you verify that money coming in the door? Is just by the bank statements themselves, and how do you project future income based on that?
Total deposits is what we're looking for. If they're depositing 10 grand a month, that's good enough for us. We'll have a track record of that, so I'll have 12 months or 24 months of that. We're thinking right now, if you got to be in business for at least 2 years, so I'll ask you for a self-prepared letter saying that you've been in business for 2 years. If you're only giving me 12 months bank statements, so we figure if you've been in business for 2 years and you're making the money, chances are you're probably still going to make the money. I mean, right now everybody's taking a little bit of a hit, but we're not expecting this to last forever.
Okay, that's a good point. I've asked most guests to come on the show, and of course, we're all struggling with both staying at home and trying to predict what's going to happen to the future. But I'm going to put you on the spot. What do you think is going to happen, and how quick do you think it's going to happen?
I think our government programs will turn on fairly quickly. All predictions are that the last quarter of this year, going into the first and second quarter of next year, are going to be amazing. That the rates are going to hit all-time lows. That the refinance boom is going to go through the roof. That we'll be seeing rates 30-year fixed in the low twos, rates that we've never seen before. We're thinking the administration is really going to do something to get everything moving again. So we're trying to gear up for that. NANQ, I think that's a whole different animal. I think that appetite will definitely come back, but I think it'll take a lot more time.
Yeah, I think a lot of the borrowers, obviously the refi boom, right? It's been used by the economy, by economists, keep the rates low, people will refi. And that's a way by which we're sort of buying our way out of recessions in the past. And it's worked in the past. I think it could probably help this time. But for those 30% of the market that is yet to be serviced because that pent-up demand can't meet a loan, you're thinking longer then, right? Year, more?
Well, I'm thinking for government loans, maybe the last quarter of this year, but for NANQ, yeah, I'm thinking about a year, a good year. I think it'll come back little by little, but we were getting a little aggressive, and right now us Loan Stream, we're holding about 80 million from the last month of NANQ, so we're still trying to get rid of that, and we're not having a whole lot of luck. So that's kind of tells us, it's going to take a little bit of time for it to come back, for that appetite to come back.
Interesting. Okay, let's talk about that for a second. So on the books of your company is a large sum of money based on loans that you can't sell to the secondary market. That's what you're saying, right?
Correct.
Okay, so in that, there's a difference between the government buying loans, Fannie, Freddie, Ginnie, and the private sector buying loans. In the non-QM space, the private sector investment has disappeared. That's why we don't have non-QM loans, right?
Absolutely.
So in order to attract non-QM back, there has to be, I guess, stability in the job market and a way to make money. And so...
Absolutely. Well, these loans have always performed.
Right.
Always performed. These loans, investors make a whole lot of money on these loans, so I don't see them disappearing completely. But like you said, there has to be the appetite. People have to be back at work. They'll have to. Right now, everybody's going to be taking a hit. So in 6 months, when the end of the year comes, and people want to do something, they're going to be hitting in the income. If they made $75,000 in 2018 or in 2019, then they're going to make maybe $50,000, $45,000 for 2020. So there's got to be something that comes in. So that's what I'm thinking is going to start happening. We'll start relaxing a little bit.
Yeah, I hope so. The assessment of risk is based on the model that we've always used, right? I mean, it's, the monthly payment. Can they make the payment? What are the likelihood based on the current environment? Do you think that this particular health-related recession, and that's what it is, it's health-related. It wasn't about anything of bad loans. It wasn't about, some duping of a large investor that caused issues with, liquidity at certain lend. It was none of that. Do you think there's the possibility that when a vaccine or something that will guarantee people's health, do you think you see a quick, like what they call a V shape, or is it more long term? Because everyone I'm talking to says long term. And I'm thinking, well, okay, but at the same time, the demand is there. And so I guess I don't understand it. Maybe you do. Explain
Well,
it to me.
I think I'm thinking more like you. I think the government loans, the FHAs, the conventionals, the Fannies, the Freddie Mac, I think that'll all come back quickly. I think people are dying to do something. There's
Right.
inventory. Somebody wants to get a house. I think those will jump back. I think it might take a little bit longer for DPA to come back, but I'm sure they'll come back fairly soon. The NANQs, I think it will take longer. The stated loans, the I-10 loans,
Right.
so that'll definitely take a little longer. I think we're looking at those hitting their stride maybe the middle of next year, around summer.
Okay. Yeah, well, that's really not that long. I mean, if you remember, the recession of '08 took us 10 years, really, or 6 or 7 years to get back to full steam again. So I don't think it's going to be that long. Anyway, we're up against the clock, Tomas. Really appreciate you coming on the show once again. You always bring great information, and thanks very much. That's Tomas Trujillo from Lone Stream. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
And your voice in the mortgage industry. We are here each and every week, and thanks for tuning in. We're on, I guess, 5. Are we on 5 now, Carol? 5 stations?
Yes, we are. We're in Albuquerque.
What are the call letters down there?
KMIN and KMYN.
KMYN and KMIN down in Albuquerque.
K-Mine Country.
Okay, excellent. And there are new affiliates, so thanks very much. People down in Albuquerque, the show itself is one which tries to help you with decisions you're going to make on getting a mortgage. I know it doesn't sound like the juiciest of programs, but the more you listen, the more you'll hear not only my opinion, but opinion of people in the business, people who do this every day, whether it's agents or loan officers or presidents of banks or home inspectors or psychologists. There are lots of reasons to listen to the show because you need the information, and trusting out there is not one of the things we do when we make big financial decisions. So thanks very much for tuning in, and thanks very much for listening to the show. We are on a number of podcasts, Google Music Play, iHeartRadio, Spreaker, I guess Apple Music Play. Is that right? Apple Music Play, is that what it is?
Apple Podcast.
I'm sorry, Apple Podcasts. So if you go to any of these major podcasts and type in Jeff Barton, the Mortgage Voice, this will come up. That gives us exposure to many, many different people all over the world, and we do actually get listeners from all over the place. We are also on YouTube, so if you go to YouTube, Jeff Barton, the Mortgage Voice, you can hear this as well as hundreds of other shows that are there from our archives, and we certainly have a number of different guests in different eras. In this particular era, we are looking for solutions. We lost an entire segment of the marketplace, that non-QM sector. And what is non-QM? It's the out-of-the-box loans. I mean, most lenders right now that are selling to Fannie Mae, Freddie Mac, or Ginnie Mae, they are standardized loans. They are conforming limits. What's a conforming limit? It is a limit that the county that you live in sets for the median house price in that county. And so if you have a loan which is in conforming limits and you are putting, let's say 20% down, and you have a 700 FICO score, no problem getting a loan. But if you're anybody else, if you have a bank statement loan, if you want to use a business bank statement loan, if you are a foreign national who wants a loan, if you happen to be somebody who has equity in their home but not necessarily a lot of money in the bank, if you have a great job but your FICO scores aren't bad, all of these types of loans used to fit into the non-QM space. Well, we've lost 30% of that market. So what happens to those borrowers, and what happens to the borrower who needs help but who can't necessarily go to a standard cookie cutter loan? Now, I say cookie cutter loan. In this environment, there is no such thing as a cookie cutter loan. Every loan is scrutinized. Every loan that's out there and every loan that you're looking to get as a result of you wanting to buy a house or refinance is looked at very, very closely. The last thing anybody who lends you money wants to do is to lend you money, and then while they're waiting to have that loan purchased, you go into forbearance. Forbearance is the forgiveness portion of the SAFE Act, not the SAFE Act, it's the, what's it called? The SCARE? No, the SHARE, what is it called? The CARES Act. That's what it is. I apologize for that. It's the CARES Act. And all the acronyms that they use in terms of all these government programs are somewhat confusing, especially when you're trying to convey it to an audience. So the CARES Act has it that these particular loans, the loans that we're talking about, in forbearance, you don't have to pay your loan for up to a year. So those particular numbers, yes, about 4.5 million people right now are in forbearance. Now, we don't know the exact numbers because some people who went into forbearance for a month now are out of forbearance, but they're still counted in the overall number. Some people who didn't go into forbearance but are now, after 2 months, going into forbearance, are they included in the number? So we're not quite sure what it is, but the forbearance, the people that we're trying to assist get loans, once they go into that, we had some guidance come up on Tuesday from FHFA, the Federal Housing Finance Authority, which talked about how those particular people are going to be affected. We in the lending industry knew right away that there was going to be an issue. Even if you said you don't have to pay for a while and we're not going to put it on your credit report, well, it has to get reported, and it has to get reported somehow. So FHFA sent out some guidance to the TransUnion, Equifax, and Experian about what they're supposed to do and how it's supposed to be reported. Well, it does get reported, and it does show up on your credit report. It doesn't hurt your score, but anybody who's lending money is going to look at the details of that credit report. And when they do that, they're going to see that, yes, you are in forbearance. So what has Freddie Mac and Fannie Mae and FHFA done in order to try to help in that situation? So they came out with a couple of new, and they do this all the time, by the way. This isn't like a one-time you're done. It isn't a rule that's set in stone. It's an evolving thing. It's kind of like the coronavirus itself. Every day there's a new guideline, a new bit of the information that we need, and a little more of the puzzle being solved. So it's an evolving process. So let's get to it. Let's see. On the 19th, this was last Tuesday, getting new mortgage after forbearance. These are for people who have forbearance, who either want to refi because they want to take advantage of low rates, or they want to buy a new home, sell their home and buy a new home, but they still have this forbearance on their credit report. Even though it hasn't affected their score, it's still on the credit report. So what did Fannie say? They said that they will buy the loans from these people, which allows lenders to lend, because now they know they're not going to get stuck with that loan on their warehouse line. And that's a real important thing. You must keep the money flowing. If it gets stuck, it's stuck for everybody. That's why it's important that the GSEs, government-sponsored entities, purchase these loans. Okay, there's a couple of requirements. These are the requirements. They presume that you have started to make payments. Let's say you're in forbearance. If you start up the payments again, you took forbearance for 2 months, now you're starting to pay again. You need to be continually paying, and you need to be paying, this is the second requirement, for at least 3 months. If you meet those two requirements, you can get the refi. And that's really important when people have equity locked up in their homes. I know most of you out there who have owned a home for 20 years or so, you certainly have equity in your home. And taking advantage of that equity, especially in a time where you may have zero money coming in, is extremely important. So to be able to tap into that, this coupled with the non-QM space opening up, and I spoke to a president of a company today who told me that give him 2 weeks, they're going to have a couple of new loan offerings coming out for the non-QM people. We are still trying to get our arms wrapped around it, what kind of economy, what kind of borrower is out there and eligible for these kind of programs. Certainly, if you're somebody who doesn't have a job and can't pay, that's going to be difficult for a lender. But if you have a blemish on your credit because of the forbearance, even though it didn't affect your score, this is one of the solutions that they've come up with. The non-QM space coming back, that's another of the solutions available for you out there. Let's see, what else do we have? Okay, right. The GSEs will buy with one missed payment. So that means that these two requirements, plus the GSEs purchasing your loan, again, will allow your local lenders, the people in your neighborhood, and I'm sure you know of a mortgage broker, or you can just search online, they will be willing to purchase if you've only missed the one payment. Now, what happens if you have missed more than one payment? Those guidelines, I don't know. And I think it's a case-by-case situation when we get into that, because let's face it, if you're lending money to somebody and you want to make sure that you can lend money to the next person, you have to get that loan purchased off your warehouse line, right? I borrow money, Malibu Funding, the company I work for. Yes, we borrow money and we lend it out. And when we lend it out to somebody, the important thing is that we get it purchased by the investor. Once the purchase by the investor, or those that sell direct to Fannie Mae and Freddie Mac, it replenishes the pool to be able to go out and lend it to somebody else. That's how the whole thing works. And as I said earlier, when it's frozen for everybody. And that's something we just can't do. So every time we get a new guidance and a new process, it's really important because it opens up the availability of funds for everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.